A very warm welcome to you, and thank you so much for coming to watch the video today.
Yeah, thanks for joining us. We've got a really great one lined up.
We absolutely do. Today, we have a clear mission. We are unpacking PayPal's fourth quarter and full year 2025 earnings call.
And man, it is a dense one.
It really is. This is a fascinating look at a tech giant in total transition. You're looking at a company that is balancing some absolute record-breaking wins in certain areas of their business, right? But on the other hand, they are urgently executing a massive multi-year turnaround plan right in the center of their core checkout business.
A turnaround that is definitely long overdue, I'd say.
Exactly. So we're going to take a deep dive into the source material from this call, look at exactly what the leadership is saying, and figure out how they are navigating this incredibly pivotal moment.
I'm ready when you are.
Okay, let's unpack this. Because right off the bat, there was a major bombshell at the very top of the call.
Oh yeah, they did not waste any time.
Not at all. We are talking about a sudden leadership change announced by the interim CEO, Jamie. The recent board chair, Enrique Lores.
Who a lot of people might know as a former HP executive.
Yes, exactly. He is officially taking over as the new president and CEO of PayPal on March 1st. He's stepping in to replace Alex Chriss.
That is exactly right. And you know, the reasoning behind this shakeup is incredibly telling. The company was remarkably candid on this call.
They really didn't hold back.
They didn't. They flat out admitted that their execution was simply, to use their exact words, not fast enough.
Which is a tough pill to swallow for a company that big.
It is, but they realize they haven't moved with the level of focus that this current hyper-competitive market demands, and that is exactly why Enrique Lores is being brought in. He has a very specific background.
Operational discipline, right.
Completely. He is known as a seasoned chief executive who specializes in disciplined execution, simplifying highly complex businesses, and leading large-scale corporate transformations.
The board clearly looked at the situation and decided they needed someone whose entire track record is built around relentlessly enforcing that discipline.
Exactly. It is a massive shift, especially when you consider that they are doing this while certain parts of their business are actually crushing it.
Yeah, we really should highlight those highs because they are significant. Take Venmo, for example. In 2025, Venmo generated approximately $1.7 billion in revenue.
That's a massive number.
It is. That is up 20% year over year. And they officially crossed the milestone of 100 million active accounts.
To have 100 million people actively using a financial app, that is a staggering competitive moat.
Truly. And then you have their enterprise payments division, which just marked its 7th consecutive quarter of profitable growth. They actually returned to double-digit volume growth in the fourth quarter.
Which is great momentum.
And on top of that, their buy now, pay later offering delivered over $40 billion in total payment volume. That grew more than 20% year over year.
What's fascinating here is how the narrative around these specific assets has completely flipped.
How so?
Well, not too long ago, Venmo and the enterprise payments business were viewed as, relatively small contributors to PayPal's overall profitability.
Right, like they were nice to have, but not the main event.
Exactly. But fast forward to 2025, and those two businesses alone drove nearly half of the company's 6% transaction margin dollar growth.
That's incredible.
They have evolved from being these interesting side projects into absolute foundational pillars. They are currently carrying a lot of the weight for the company's bottom line, while leadership tries to fix the older parts of the house.
Which brings us to the low point of the call, and really the core problem they are trying to solve. Online branded checkout.
The elephant in the room.
Yeah, this is the classic recognizable PayPal button you see when you are shopping online. When you look at the numbers for that specific button, it's pretty sobering.
Very sobering.
Their total payment volume for branded checkout barely moved. It eked out just 1% growth in the fourth quarter.
And to put that in perspective, that is a steep and sudden deceleration from the 5% growth they saw just one quarter prior in Q3.
So what exactly happened there? That's a huge drop-off.
The management team broke down 3 specific reasons for this sudden slowdown. It is basically a perfect storm of macroeconomic and operational factors. First, they are dealing with major U.S. retail weakness.
They called that a K-shaped economy. Right.
Yes, exactly. For those following the retail space, a K-shaped economy essentially means that while high-income consumers are continuing to spend as usual, lower and middle-income consumers are pulling back heavily on discretionary spending.
And that lower and middle income group happens to represent a massive, historically loyal demographic for PayPal's core brand.
Exactly.
Yeah.
Second, they're facing stiff international headwinds. Germany, for example, is one of their absolute largest markets globally.
Right.
Management openly acknowledged that they are losing market share there to alternative payment methods as their historical dominance begins to normalize. And third, there was a significant cool down in some of their previously high-growth verticals.
Like which ones?
Categories like travel, ticketing, crypto, and gaming. Those were booming throughout 2024, but they suddenly moderated toward the end of 2025.
So they are just getting hit from multiple angles all at once. But I know they laid out an aggressive turnaround strategy to fix this checkout issue. Could you walk us through how they actually plan to pull that off?
Absolutely. They are building this turnaround on 3 distinct pillars: experience, presentment, and selection.
Let's start with experience.
On the experience front, it is all about speed. They're leaning heavily into biometric authentication and passkeys to shave crucial seconds off the checkout friction.
Because they know that every extra click or password prompt is a lost sale.
Precisely. Then there's presentment, which is essentially a battle for digital real estate. They want their buy now, pay later messaging upstream.
Meaning they want you to see it right there on the product page before you even add an item to your cart.
Exactly. They are also actively negotiating with merchants to secure second buttons, ensuring PayPal is featured prominently right alongside their competitors like Apple Pay.
Got it. And the final pillar, selection.
For selection, they want to drive deep consumer habituation. They are rolling out a brand new unified app and launching the PayPal Plus rewards program.
Giving consumers a tangible financial reason to choose PayPal every single time they shop.
You nailed it.
That sounds like a massive, expensive undertaking. And that strategic pivot is heavily reflected in their financial guidance, isn't it?
It absolutely is.
Because if we look back at 2025, it was still a solid year on paper. Their non-GAAP earnings per share, which essentially strips out the one-time accounting noise so we can see the actual operating health, grew 14% to $5.31.
Plus, they generated $6.4 billion in adjusted free cash flow.
But then we look at the roadmap for 2026, and things change dramatically.
Right. PayPal is officially pulling back on the multi-year 2027 outlook they provided to investors last year. Instead, they are moving to provide guidance just 1 year at a time. The reason is that they are intentionally taking a 3-point hit to their transaction margin dollar growth.
So they're projecting flat or slightly declining transaction margin dollars for 2026.
Yes. They are taking those funds and reinvesting them heavily into that 3-pillar strategy to fix branded checkout. To use an analogy, they're essentially taking the engine apart while the plane is still flying.
And using the profits from their other successful businesses to buy the new parts.
Exactly. They are accepting short-term financial pain for long-term stabilization.
That is a massive strategic gamble. And you could absolutely feel the palpable tension and curiosity from Wall Street as we transitioned into the Q&A session of the call.
Oh, the analysts were definitely hungry for answers.
They wanted answers on exactly how this was going to work. Let's dive into that Q&A session because the back and forth reveals so much about the company's internal mindset.
Where should we start?
Tianjin Huang from JP Morgan jumped in first to ask a really pointed question. He wanted to know if this sudden change in CEO timing is primarily to address execution, or if there is a risk of wholesale strategy changes that could delay the turnaround even further.
It was the elephant in the room. And interim CEO Jamie clarified immediately that this is strictly an execution issue.
So no tearing up the playbook.
None. He emphasized that the incoming CEO, Enrique Lores, is not coming in to rewrite things. As the board chair, Enrique has been deeply involved in setting the exact strategy and the 2026 plans that they are currently executing.
The company stated he is being brought in specifically for his operational discipline and his ability to drive much faster decision-making to accelerate the current plan.
Not to rewrite it from scratch, exactly.
That brings up an obvious hurdle, which Ramsey LSL over at Cantor Fitzgerald actually challenged them on next.
That was a great question.
His question was essentially this. If this modern checkout offering is really as compelling as PayPal claims, how do you actually force the issue and get merchants to adopt it amid such heavy competition?
The company's response to that question was quite revealing about their past missteps. They admitted they are entirely abandoning their old spray and pray approach.
Where they basically tried to push upgrades to every single merchant globally all at once.
Right. Instead, they are moving to a sniper approach. They are deploying dedicated, mission-based teams to hyper-target the top 25% of strategic merchants.
So focusing on the big fish.
Yes. They are packaging the latest integrations, the biometrics, the upstream presentment as one bundled solution. And crucially, they noted that they are often tying PayPal's economics directly to performance.
Meaning they're structuring deals where the merchants share in the financial upside when conversion rates improve.
Making it a win-win.
I thought the exchange with Darren Peller from Wolf Research right after that was particularly telling.
Yeah, he got right to the financials.
He basically asked for a timeline. He wanted to know when these investments will actually bear fruit and how the company is balancing these growth investments against capital returns to shareholders.
Right, and CFO John Rainey, alongside Investor Relations Chief Steve Wynacor, had to step in and do some serious expectation management there.
What did it say?
They noted that the financial headwinds from these investments will hit evenly throughout 2026, starting right away in Q1. They were very careful not to predict a massive hockey stick-style recovery in the back half of the year.
Just emphasizing that they need to see the data as the programs scale.
Exactly. Regarding capital returns, they reassured investors that they are still committed to doing $6 billion in share buybacks and continuing to pay their dividend.
But they made it crystal clear. Organic investment into the core business is the absolute top priority right now. Everything else is secondary to fixing the checkout.
Which flows perfectly into the question from Sanjay Sakrani with KBW.
Right. He wanted to know exactly what is embedded in the 2026 outlook. And specifically asked if incoming CEO Enrique was involved in setting these new expectations, given that he's the one taking the hot seat.
Management laid out the specific numbers embedded in their guidance. They expect flat transaction margins excluding interest, a 3% increase in operating expenses to fund these new investments, and non-GAAP EPS to range from down low single digits to slightly positive.
Did they confirm Enrique's involvement?
They firmly confirmed it. He was not just aware, but actively reviewed and shaped this 2026 guidance and the overall capital allocation strategy before it was presented to the public. He is fully bought into these numbers.
Here's where it gets really interesting. Andrew Schmidt from KeyBank Capital Markets asked a fascinating question about the root cause of the issue.
This was a crucial distinction to make.
He asked whether the shortfall in branded checkout is more attributable to a clunky experience on the merchant side or a lack of engagement on the consumer side.
The company's response to that was essentially that it is a mix of both.
Makes sense.
They reiterated that macroeconomic pressures really battered their core middle-income consumers. But to address the consumer side of the equation, they detailed their upcoming launch of some very powerful loyalty programs.
Like Stash for Venmo.
Yes, which uses gamified onboarding and tiers of rewards to drive daily engagement. They also teased the upcoming global rollout of PayPal Plus, which is designed to reward users for both online and offline habits, including things like interacting with crypto.
They fundamentally believe that giving consumers a financial reason to choose PayPal over a regular credit card is the missing link.
That is the big bet.
It makes a lot of sense, but it also sounds expensive. Harshita Rawat, with Bernstein, asked a very blunt question about that exact dynamic.
She definitely didn't sugarcoat it.
She asked, can the branded business truly be turned around against such fierce price competition in the market? And can the company's earnings still grow if branded checkout doesn't actually improve?
If we connect this to the bigger picture, the company's response to that question really highlights their underlying resilience.
How so?
Well, they stated that the investments they are making to fix branded checkout are multi-year commitments. They're focused on adding real, tangible value to the checkout experience, rather than just engaging in a race to the bottom on price.
Right.
But to answer the second part of her question, they pointed out that 2025 proved their diversified assets are incredibly strong. They highlighted their enterprise PSP business, which acts as the back-end payment service provider for massive global merchants, along with Venmo, debit, and credit.
So even with a sluggish branded checkout performance last year, those other assets still drove mid-teens EPS growth for the entire company.
Exactly. It's a great safety net to have.
It really is. But Dan Dolev from Mizuho pushed back on how they allocate resources across that network.
Oh, this is a great structural question.
Given the undeniable power of their two-sided network, he asked why the company doesn't just focus 100% of its resources on merchants to drive growth, instead of splitting their focus with consumer programs or share buybacks.
The company's response was a fundamental defense of their business model. They argued that you simply cannot win without serving both sides of the network simultaneously.
Because merchants are only willing to work with PayPal and integrate their software, because PayPal brings a massive engaged consumer base to the table.
Exactly. Conversely, consumers will only use the PayPal app if it is smoothly and widely integrated at the merchants they actually want to shop at.
You can't starve one side of the network to feed the other. It has to be a symbiotic relationship.
That's the core of their entire philosophy.
And finally, Jason Kupferberg with Wells Fargo rounded out the major themes. He asked if asset sales are on the table under the new CEO and what the branded checkout growth actually looks like right now in early 2026.
This raises an important question about the company's ultimate structure going forward, but the company definitively stated that asset sales are not the plan.
So they are keeping the family together.
They are. Their focus is entirely on organic transformation and better integrating the unique assets they already own rather than selling them off for parts.
Did they give any color on current performance?
They did. As for the immediate performance, they offered a slight glimmer of hope to end on. They noted that for the first quarter of 2026, branded checkout volume is currently tracking slightly better than the 1% growth they reported for Q4.
So what does this all mean? When you look at the prepared remarks, the financial adjustments, and that incredibly direct back and forth from the analysts, how do we synthesize everything we've just unpacked for you?
If I had to summarize the main themes from both the presentation and the Q&A, it's that PayPal is finally ripping the Band-Aid off.
Yeah, that seems to be the consensus.
They are publicly acknowledging that their execution in their core branded checkout business has simply been too slow for the current market reality.
And they are bringing in a new CEO specifically to enforce a rigorous operational discipline that has been lacking.
Exactly. And perhaps most importantly, they are willingly choosing to take a short-term financial hit to their margins in 2026 in order to fund a massive multi-year technological and marketing turnaround.
Abandoning the spray-and-pray merchant strategy for highly targeted, value-driven deployments.
Right. And meanwhile, they have the luxury of their highly successful side businesses, like Venmo and enterprise payments, pulling a tremendous amount of weight to keep the overall company highly profitable while they rebuild that core engine.
It is a remarkable balancing act to witness. We are going to be watching very closely to see how Enrique Lores steers this ship starting in March. Thank you so much for watching the video today. We really appreciate you spending your time with us. If you liked the video, please click like, share the video, subscribe, and definitely stay tuned for upcoming content as we continue to dive into the most fascinating stories in business and tech.
And I want to leave you with one final provocative thought that builds on some of the source material we reviewed today.
Oh, this is a good one.
Tucked into the transcript was a brief mention of something called agentic commerce.
Right, agentic commerce.
This is the idea of AI agents actually buying things on behalf of consumers through platforms like Perplexity and Microsoft Copilot, which PayPal is already integrating with.
Which is wild to think about.
It is. If AI bots start doing our shopping for us in the near future, how will consumer loyalty programs like PayPal Plus or Venmo Stash even matter?
That's a great point.
Will the battle for checkout dominance completely shift from trying to win over human psychology with rewards to simply writing the best, most frictionless API for an AI to interact with?
It's a fundamental shift in how commerce might work.
It really is. Something for you to chew on until next time.